Investors, they are on edge ahead of a make or break week for the markets. We've got 4 Magnificent 7 names reporting earnings, the Fed decision on Wednesday, monthly jobs report on Friday. And joining us now to walk through all of this is Liz Young Thomas, SoFi head of investment strategy. Liz, it is great to see you. So I don't know if we were just talking there about those big tech earnings on deck, Liz. So Apple and Amazon, Meta and Microsoft. You know, we did hear from Alphabet and Tesla investors kind of underwhelmed. What do you think we're going to hear from those big tech names this week, Liz? What do you expect to hear? How important is that for the market?
Well, it's very important for the market still this quarter. We've had this period of time where each quarter the Mag 7 stocks have been responsible for the majority of S&P earnings. In fact, there were a few quarters that earnings would have been negative without them. This quarter, those Magnificent 7 stocks still should be responsible for about 60% of earnings for the entire index. So they're very important for sentiment, for investor sentiment right now. And that's the reaction that we saw in the market last week. Obviously, we're going to get more names this week. Very important for sentiment as well. I think one of the things that is going on is that we're hearing continued spend on AI, and I think for good reason. Companies are excited about the optimism of AI, but there's been a lot of spend that's already occurred, and investors are now at the point where they want to see where the profit is going to come from. They need to understand all the use cases. Where is the productivity going to come from? So rather than just continuing to spend with no return, now investors are starting to demand some return on that spending. So there's a little bit more discernment going on in the market, going on with commentary that we hear out of these big stocks. And it's no longer just a rising tide lifts all ships sort of theme.
And Liz, you know, we've been talking to a number of strategists who are saying, okay, maybe hold on to your big tech. Don't necessarily do anything with your big tech, but maybe it's time to add in other areas that may be seeing more upside this earnings season. Is that something that, you know, a way that you're thinking also? And if so, where are you looking?
Well, that would tell me that if you're holding on to everything that you currently own, but you're allocating somewhere else, that means you have to take money out of cash, perhaps, or out of another asset. I don't know that investors are quite ready to take all of that money out of a still high-yielding money market fund and still pretty high-yielding treasuries in some cases. So I think what's going on actually right now with the rotation is that some of those big cap tech names have given some back, because when people look at their portfolios, that is the easiest stuff to sell. You've got a big gain in it. It's a very liquid name. Professional investors see those as easy to sell as well. So it's an easy place to take some profits and rotate. And I think the beneficiary of that rotation right now, the biggest beneficiary has been small caps. And that rotation has largely been predicated on technicals, because there now is momentum behind small caps, so it continues to feed on itself. By fundamentals somewhat, because small cap earnings are expected to pick up, although small cap earnings have certainly not kept up with large cap earnings. And then the last piece of it is valuation. Small caps have looked much more attractively valued. But what I would caution investors on is throwing all of their chips at that small cap trade on the expectation that we are in this never-ending economic expansion. Nothing lasts forever, and we're embarking on probably a Fed cutting cycle in fall, which is typically a volatile experience for markets.
Liz, I want to pick up there on the Fed. We do have that big meeting this week. Alan Blinder, of course, former vice chairman of the Fed, Liz, he had an editorial in the Journal saying the Fed should cut interest rates this week, Liz. What do you make of that?
Well, right now the market thinks there's a 4% chance of the Fed cutting interest rates this week. And I don't think that Jerome Powell likes to surprise markets that much. So I would be shocked if they cut rates this week. I still think September is the first cut. There is chatter now about September being possibly a 50 basis point cut. I still view that as a very contrarian view. But we have a lot of data that we're going to get between now and that September 18th meeting. So we obviously have jobs coming this Friday. I think that's a very important number. And then in August, we have more CPI data. We have more PCE data. We have more jobs data. So we're going to get a decent amount of data before they have to make that rate cut decision, whether it's 25 basis points or 50 basis points. And we're going to hear from Powell, obviously, this week. We're going to hear from him again at Jackson Hole. So there are a couple opportunities for the Fed to shift their own commentary to become more dovish if the data warrants that.
Liz, I don't know if Jay's going to be quoting some 80s sitcoms like you did in your recent note, but we enjoyed some of your references there. But as you ask Who's the Boss, of course, one of everyone's favorites from that era. And you talk about the consumer being the boss here. So I'm just curious, between now and September, what consumer reports are you really zeroing in on?
Well, we're always looking at things like personal income. We're always looking at retail sales, and we will get some more information on that as well. The reason I talk about the consumer being the boss is because, as we know, it makes up the majority of our GDP. And as you look forward in the year, GDP is expected to slow to below 2% for the third and the fourth quarter. That's likely happening because the consumer is expected to pull back a little bit. That doesn't mean that there's a huge catastrophe coming. It just means that we know the consumer has been pressed by the cumulative effect of inflation, and they've started to pull back on some of that discretionary spending. That's usually the first stuff that gets hit, is the discretionary items. So what you really want to watch is the results from consumer discretionary, but also consumer staples companies. How is their revenue doing? How is the activity in the stores doing? Big box retailers. Those are going to be good tells, I think, this earnings season and in Q3.
And Liz, finally, I want to circle back to earnings because our morning brief chart of the day today looked at reactions this earnings season in stocks versus what we've seen over the past 5 years. And, you know, whether companies beat on earnings and revenue, whether they miss on one and beat on the other, the theme that's constant is that the moves are bigger this time than they have been compared to the 5-year average. We've got this uptick in volatility. What do you think that's a reflection of, and do you think that that's going to continue throughout the remainder of the season?
Yeah, what this chart tells me is that we get rewarded more on the upside, but punished much more on the downside. So punished much more for those surprises in the negative way. I think part of this is a little bit of muscle memory. Investors have been conditioned over multiple quarters that all companies should just beat on earnings. And that has happened for a while. We've had expectations be beat many, many quarters in a row now. So I think we're used to that. We're expecting it. So when we do hear some of these misses, they feel more dramatic because it hasn't happened very much in the past. But it is normal. And especially at a time like this where we don't have a ton of clarity on what the path of rates will be. We don't have clarity on the political environment in the U.S. This is a tough time for businesses to do planning. And it's more likely for them to have some inventory mismanagement issues, maybe overhiring, underhiring, because they're trying to forecast a very murky environment.